This is Stockwatch with Chris Pedersen on Wednesday, the 1st of November, 2023. Any advice provided is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. A few of my observations in the market. Oil remains low with WTI, which stands for West Texas Intermediate, being under $82 US per barrel. This indicates two things. One, expectation of a global economic slowdown. And two, that right now there's not an expectation of the war in Gaza expanding. This is very significant. However, we know that if that war expands, instantly oil will shoot upwards. Iron ore is at US dollars 120 per ton. That is significant. It has not shown weakness. This shows that China, even though it has a lot of real estate problems, is continuing to spend money on infrastructure and roads. Longer-term interest rates in Australia and the US are rising, which hinders equity price growth. My RBA comments are that average household spending has declined on a per-person basis. What is driving growth is population growth. To get inflation under control, I feel we need to increase production of goods and services, not reduce household spending further for struggling families through higher interest rates. The RBA meets in 6 days for their overnight rate decision. Right now in the market, it's priced at 60% probability of a rate rise. I'm not so sure the RBA will raise, however. Biggest contributors to inflation are not influenced by interest rates. For example, petroleum prices for moving around, rents, and energy prices for industry and households. Plus, the impact of rate rise is not fully realized through our economy. Here's a fascinating chart that tells you a lot more than it tells you on the surface. This is the UN truce resolution for Gaza and how states voted. Blue states said yes for truce. The other states said no or maybe, but let's not have a truce. We see Russia and a lot of Asia is voting for truce. Then we see a lot of Africa and a lot of South America and Central America. The US, Australia, and our allies in Europe all voted against a truce. I guess this is to make sure that there's finally a resolution to the Hamas terrorism, and perhaps then there can be a two-state solution. It's a complicated issue, but this is not just about the resolution. This is about global influence and who has what in looking at this chart. This is another fascinating chart that came across my desk this week. This is in China, the ratio of unfinished housing units to completed housing. What you see right now is there's a massive ratio of uncompleted housing. It has only spiked up. So this tells you that all the news that maybe China's getting control over its housing crisis, no, it's not happening. However, China is using their tools of a state-controlled economy to try to keep things under control in other areas. 3 companies that I wanted to share with you today, and the reason I chose these is, 1, they're all defensive in nature. They are not necessarily interest rate sensitive, or if the market drops, they might not drop along with the market. Now, there's an old adage, and it is true historically, that in a falling market, 80% of all stocks fall with it. In a rising market, like 70-80% of all stocks rise. So Warren Buffett's saying of the market's like the tide, that when the tide goes out, the boats decline, meaning equities, and when the tide comes in, boats go up. So this first company, QBE Insurance, it's currently trading at $15.60. One thing about insurance companies is that when interest rates rise, they become more profitable because of all the premium income that they're holding on to. They earn higher rates of return on that cash. With QBE, the fundamentals are the following: that it has a market cap of $23 billion and a 12-month price target, I estimate, $19.25. The revenue growth for each of the next 2 years of 2023 to 2025 is estimated to be 25% per annum. That's extraordinary. Earnings growth from 2023 to 2025 is 24% per annum, along with dividend growth of 32% per annum. On a PE basis, off of next year's earnings estimate of $1.21, it's only a PE of 12.9 times. This is because QBE has various risks, which I'll cover in a second. The yield on the 2024 dividend estimate of $1.01 is 6.5%. The return on equity is 15% at current price, and its dividend payout ratio is just around 50%. If broker forecasts come to fruition, QBE is one of the cheapest companies on the ASX right now. The major risk is multiple large catastrophes. I rated a buy. Now, going back to catastrophes, the insurance industry is getting a lot more sophisticated at being able to spread the risk. There's a lot of new products that they're utilizing as a mechanism to securitize risk. This is positive for being able to sustain catastrophic risk. This company is kind of under the radar for many investors. Data3 Limited. The code on the ASX is DTL. Currently it's trading at $6.88. If you look at the chart though, this is a 5-year chart. It's a very strong bullish pattern. And you look where COVID was, it didn't really drop. So this is definitely a defensive company also. These are UBS estimates, and with a market cap of $1.1 billion, UBS is saying their price target is $8.20. They estimate revenue growth for each of the next 2 years at 11%, with an earnings growth rate of almost 12% and dividend growth at almost 13%. Very strong, very healthy. The PE on next year's earnings estimate of 27 cents is a little high at 25 times, but it's not that high for a company that's performing like this. The yield on next year's dividend of 24 cents is 3.5%. This is attractive. A lot of growth stocks don't have dividends with a yield this high. Free cash flow averages around 5% over the next few years, and the payout ratio is large at 91%. It's a software reseller. Major brands are Microsoft, Cisco, Hewlett-Packard, and Dell. What they do is they resell, but they also package solutions for their customers. It was listed in 1997. I rated a buy. And the last company today is Computershare. I've liked this company for years. The code is CPU, and it's currently trading at $24.93. And again, take a look at the chart here. It has recovered dramatically from COVID, and it has been strong ever since. On a fundamental basis using Citibank numbers, they have a market cap of $10 billion. The 12-month price target is $29. That's extraordinary. They're a little bit on the high side for brokers around town, but nonetheless, most brokers rate it with a pretty high price target. Revenue growth from 2022, which is different from the other companies, to 2025 is 3.6% per annum. The reason I did that is because 2023 had some extraordinary numbers that on the revenue side I thought I wanted to strip out to get a cleaner picture. The earnings per share growth for 2023 to 25 per annum is 6.1%, and the dividend growth in the 2023 to 2025 period is 13.4% per annum. The PE on next year's earnings estimate of $1.17 and change is 21 times. That's kind of in line with market. The yield on the next year dividend estimate of 85 cents is 3.4%. Again, this is attractive. Free cash flow is around 5%, and the payout ratio is only 72%. This is a steady performer. They are a stock issuer services, share registries, corporate trust, and employee share plan administrators. I've liked CPU, as I mentioned, for years. I still rated to buy. It is defensive. As always, if you want to learn more about anything I covered today, send an email to stockwatch@fnn.com.au. And if you have any company or any financial matter you want me to cover, send me an email and address it, attention Chris Pedersen. Thank you for your time. Have a wonderful week.